Hello and welcome to the Global View on this Wednesday. Well, the US dollar and Treasury yields have fallen after Fed Reserve Governor Christopher Waller flagged the possibility of cutting interest rates in the months ahead if inflation continues to fall, saying, "I'm encouraged by what we've learned in the past few weeks. Something appears to be giving, and it's the pace of the economy." And Chicago Fed President Austin Goolsbee is also encouraged by what he's seeing, saying, "Overall, we have made progress on inflation outside of the food sector. It's been coming down. Not yet down to target, but 2023 we're on the path to set the highest drop in the inflation rate in 71 years. However, the dovish commentary is odds with Fed Governor Michelle Bowman, who said, "My baseline economic outlook continues to expect that we'll need to increase the Fed funds rate further to keep policy sufficiently restrictive to bring inflation down to our 2% target in a timely way." Well, financial markets have priced in an almost 99% likelihood that the FOMC will keep the Fed funds target rate at between 5.25% and 5.5% when it meets next month. Bond markets interpreted the mixed Fed speak as dovish, with yields moving lower, the 10-year falling to 4.34% and the 2-year down 9 basis points to 4.76%. US consumer confidence has risen this month after 3 straight monthly declines, although households continue to anticipate a recession over the next year. That's according to a survey by the Conference Board. And home prices were up 6.1% year on year in September. Well, the US dollar has sunk to a 3-month low on perceptions that the US economy is slowing. The Aussie dollar, it's risen to 66.5 US cents. Well, for more on the macro outlook, I caught up with Alejandra Grindal from Ned Davis Research live in this studio for the outlook there on the 2024 global economic outlook.
Global growth estimate for 2024 is 2.7% real GDP growth. This year, it'll likely be around 3%. So that is a modest slowdown. But putting it into a little more context, long-term average is 3.4%. So that's quite a bit slower. However, when we've been in global recession, which is typically associated with pretty bad equity bear markets, global growth has been under 2.5%. So that puts us above that threshold, but barely. So overall, I guess you would summarize that we're in that soft landing camp, but not underestimate the risk of recession. Now, you mentioned central bank policy, right? So that's the big push, right? So if we have the soft landing and we continue to see just sort of a slowdown in inflation, I don't see major central banks such as the ECB or the Fed cutting rates, say, in the first half of the year. However, in the second half of the year, again, it's dependent on data, but we could potentially see some central banks, those major ones, start to cut policy. Because effectively what's happening is if inflation slows, that nominal rate might become too restrictive. So that might give them some wiggle room to reduce the rate in order to keep the real rate just equally as restrictive.
Interesting, the outlook, particularly from the Fed. In fact, we had some conflicting commentary coming from the Fed overnight, with the likes of Christopher Waller flagging the possibility of cutting rates, backed up by Austin Goolsbee, whereas we've got more, Michelle Bowman is a little more hawkish, saying we may need to hike rates even further. It does complicate that outlook, doesn't it?
It does, and I would say neither myself nor the Fed knows exactly what the outlook will be. It's all very, very data dependent. And it's not just dependent on one data point. It's a whole combination of everything that's coming out. Perhaps some of this communication we're getting from the Fed is a lot of markets are pricing in a rate cut early on in the year, and maybe they want to try to convince markets, hey, maybe that's a little too soon to start doing that. So it could be more of a communication message. But at least from my perspective, given the state of the US economy and the inflation story, I think they're done hiking for now.
Yeah, there does appear to be a lot of wishful thinking at the
yes.
moment, doesn't it? Yeah. So let's take a look at those downside risks. You mentioned, obviously, perhaps tight policy globally. What else are you factoring in here?
Yeah, I mean, I would say that's the biggest downside risk. And it's more of a gradual process. And some countries have felt it more than others. One thing we've been discussing is that the transmission mechanism of tighter policy in the US just hasn't been quite as strong, partly because households have locked in extremely low mortgage rates. This probably blows some minds here in Australia, but we get 30-year fixed rates, and many of us at 2.5%. So that transmission of tighter policy hasn't been felt in a lot of households. So it is a bit more of a gradual process. Other downside risks include, we're not seeing massive amounts of fiscal support that's not going to be able to offset this tighter monetary policy. There's, of course, geopolitical risk. Difficult to quantify, but you have the ongoing, war in Russia and Ukraine, the crisis in the Middle East. We don't know how big that'll get. Obviously, that leads to downside risk through a geopolitical perspective, but it could lead to higher commodity prices, which could have impacts on inflation and ultimately monetary policy. So, a few outline of risks there. I think a lot of what we're going to see next year is very similar to what we're seeing, say, in Q4. So not contraction, but just not overly robust growth.
And in terms of upside risk, you mentioned obviously the possibility that they could begin cutting rates next year. Also, the labour market, which has showed incredible resilience, hasn't it?
Absolutely. So if you think about upside risk, and I think this was one of the reasons why the U.S. consumer remained pretty strong this year, is because real wages are rising. So nominal wages are obviously positive, but as inflation continues to slow, you're going to see those real wages rise. So that should continue to sort of boost growth, not only in the United States, but in other parts of the world. But you're right. I mean, the key element is the strength of the labor market. And particularly in the United States, we have seen the unemployment rate rise, over the past, several months. But one thing I do like to point out is that payrolls growth has actually been reasonably strong. One of the reasons we've seen a rise in the unemployment rate is because of a rise in labor force participation, which is not necessarily a bad thing. But in the whole realm of things, we've done calculations as to where the labor force in the United States should be right now, and we're still well below trend. So overall, that's just arguing for, continued strength in the labor market, which would support spending.
All right, so overall then you're forecasting that the US will avoid recession. It will be that so-called soft landing, and which is obviously important given the size of the US economy.
Absolutely.
And how that affects the global economy.
Absolutely. Typically, to be honest with you, when we've had a major global recession, it's always coincided with the US also in recession. I hate to say it, whenever we have issues, we like to spread our problems to the rest of the world, and I do apologize, but historically that's typically been the case.
Alejandra, let's look further afield there, other regions. Clearly, a focus for Australia is China.
Absolutely.
Because of our interdependence there, particularly in terms of trade. What's your outlook for 2024?
A lot of the same of what we've seen in the second half of the year. This year, specifically, we're looking at growth being around 5%. And we've actually been in that camp for quite some time. I think early on in the year, a lot of people were more optimistic, but we've been at that 5% mark for quite some time. In fact, I think we've discussed it in the past before. Going into next year, I think you have two overlaying factors. You have the fact that potential growth in China is slowing because of demographics and just slowing productivity growth. And then from a government side, there's no incentive to massively provide a fiscal boost. So all in all, we're looking at roughly a 4.5% growth rate in China next year. A little slower than this year, but still much faster than 2022 when China grew only about 3%.
Europe? That's perhaps when you compare with more globally, and I guess the States, it is looking weaker, isn't it? I guess particularly look at the largest economy there, Germany, some poor signs there. What's your outlook?
Yeah, so Europe, right now we're predicting just sort of mild recession, if they're actually not in one already. The Q3 number for GDP wasn't that great. We look at a number of indicators, and many of them are on the cusp of indicating recession at this point in time. Germany is obviously a key driver. A lot of it just has to do with the fact that they were so energy dependent on Russia, and they've had to do a pretty sharp transition. And then very similar to Australia, they also have ties to China. So slower China doesn't necessarily bode well for Germany. But at least if we can provide some good news, some German indicators and even Eurozone indicators have at least started to stabilize. So they are hovering around that recessionary level, but they're not just doing this free fall. They're starting to stabilize. So at least if I can provide some good news, that could, if the Eurozone falls into recession, it's likely to be mild. And then one other caveat I'd like to mention with Europe as well is that the potential growth in Europe is just extraordinarily low. It's only about half a percentage point, or not half 0.5% growth. So what that means is it's just easier for the economy to fall into recession because it just doesn't have much wiggle room.
Do you have a view on energy? Because clearly, you take a look at the oil price, it's been under pressure. OPEC Plus meeting later this week is perhaps looking to extend those supply cuts into 2024. Of course, we saw, post-COVID, that rapid rise in energy prices. What's your outlook as to, but I guess particularly in terms of global demand?
Right, exactly. So, from a supply perspective, you mentioned OPEC. You mentioned, and then there's also Russia sort of no longer providing to not all parts of the world, but certain parts of the Western world. And then even in the United States, if we're moving more toward renewable energy, if that's the long-term goal in most parts of the world, what incentive do US producers have to ramp up production, right? So you're right, from a supply perspective, there's not really much of an upside surprise coming from there. So it has to come from a demand side. So yes, if we see slowing global growth, that does provide some downside to the demand component. So I would say if you sort of balance those risks, I would say oil probably within the similar trading range it's been in so far this year.
Alejandra Grindal from Ned Davis Research. That is the global view. Just a quick check of the market before we go. We are expecting to open higher, as you can see, SPI futures up around 1/5%. Stay with us. The open just a couple of minutes away.